Hi everyone, Finance with JC, episode 3, how to avoid a disaster in retirement, the safe withdrawal strategy. I'm going to give you some statistics that might keep you awake at night, that might not. Did you know that in the US, 40% of retirees run out of money in the first 10 years of their retirement? 60% significantly reduce their lifestyle because their safe withdrawal strategy wasn't actually that safe. Most people spend 30 to 40 years building their retirement nest egg, and then they destroy it within the first 10 years because they don't understand the mathematics of safe withdrawal rates and the different strategies that go with that. So today I'm going to show you exactly how to avoid becoming a statistic. We're going to be talking about the deadly combination of sequencing risk, why the traditional 60-40 portfolio might be setting you up for disaster, and the withdrawal strategies that can make your money last 30 odd years when you get to retirement. Okay? So if we think about how retirement disasters happen, because understanding this is really important, once you understand it, you'll be able to avoid it. Say I have a client, this is pretend by the way, all my clients have great outcomes. Meet John. He retires in year 2000 with £500,000 in his pension. Read all the books, followed all the conventional wisdom in the world. He has balanced portfolio, 60% in equities, 40% in bonds, and he plans on withdrawing 4% per annum, 20 grand, which, according to all the books that he's read, should be perfectly safe, okay? And that's what all the retirement planning guides say. But John retired right before the dot-com crash, 2000, 2002. Then in 2008, we had the global financial crisis. John's portfolio got hammered twice in his first 8 years of retirement. So fast forward to 2008, when it was like Armageddon. Instead of having £500,000, well, actually he should have had more, because in an ideal world you might be making money on your investment. John had about 285 left, but he's still been taking his 20 grand a year, which is now about 7% of the remaining portfolio. He's trapped in what we call sequencing risk. Early losses combined with ongoing withdrawals to create a death spiral. John thought he was being conservative with his 4% withdrawal rate, but the timing just completely destroyed him and his planning. He couldn't control the market timing. Just turned this strategy into a complete disaster. But this is now happening to a lot of people around the world, and it could happen to you as well if you don't plan and understand these principles. So when we look to understand sequencing risk, this is like the risk of returns, and it's a silent killer is what some people call it. Most people don't even know it exists, to be fair. So the whole concept is the order in which you experience investment returns matters enormously when you're making withdrawals. Okay? If you're 25 and you're investing for retirement, it doesn't really matter if the stock market crashes in year 2 or in year 22 of your investment journey. You've got time on your side. You're adding money every year so that actually the volatility and the crashes help you buy more shares at lower prices, because again, we'll use COVID in 2020, March 2020. Everything fell off a cliff, 30% decline in March 2020. It's a great time to be topping up your portfolio. And for the people that have good financial advisors and they were coached about the journey of investments and everything else, they would have topped up, and now actually guess what? The markets are up here. But in retirement, it's completely different. If the market crashes in year 1 to 3 of your retirement, you're withdrawing money from a declining portfolio. You're selling shares at low prices when you should be buying them. So let's have a look. We have 2 retirees, okay? Both start with £500,000, both average 7% returns over 20 years. Both are withdrawing £25,000 per annum as their retirement income. Retiree A gets 7% every single year for 20 years. End result, after their income, they've got 635 grand left. Retiree B gets the same average returns, but they're minus 20, minus 15, plus 35, plus 25 in the first 4 years, and then afterwards steady 7%. Retiree B has only 180 grand remaining. Still in a good place, no doubt about it, but nearly 500 grand worse off compared to retiree A. Average returns, same average returns, hugely different outcome. That's sequencing risk for you, and it's why your withdrawal strategy is more important than your investment returns. Okay, sorry. The problem that you have with the traditional 60-40 approach that everyone does recommend, and we do as well, but when we approach retirement, we need to approach things differently. Okay. This allocation was developed in the 1980s and 90s, where bonds were actually giving you a meaningful return, 6 to 8%. The 40% bond allocation provided income, and stability. But if you look at the environment that we are in right now, government bonds are yielding 2 to 4%. Corporate bonds, higher risk, might give you 4 to 6. Okay. Meanwhile, inflation is running at 3 to 5%. So how does that compare to your real returns on bonds? 0, sometimes negative. Stocks are more expensive than historical averages, which typically means lower future returns, but again, over time, the market does go up. You have low bond yields and potentially lower stock returns exactly when you need your portfolio to perform for 20, 30 years in retirement. Okay, so the 60-40 portfolio was designed for a different economic environment. The fact of the matter is, in today's environment, it might not be enough to provide enough growth to sustain long-term withdrawals, and it might not provide enough stability to protect against sequencing risk. So you might need a bit more of a sophisticated approach, perhaps. And again, most importantly, what you need is financial advice to make sure that you are as best set up as you possibly can be. I really can't stress that enough, by the way. So what can you do today? What does a retirement portfolio look like in today's environment? Okay, so we have what I work with quite a lot of my clients is the bucket strategy. I've got 3 different buckets. Bucket 1 is immediate stability, 2 to 3 years of expenses. It's your cash, your short-term assets, ultra safe investments. Okay, so if you need 20 grand a year, in an ideal world, you've got 40 to 60 grand sat in the bank that you can just draw on straight away. Okay, this bucket isn't about growth. This bucket is protection and preservation. This bucket will protect you from having to sell stocks during market crashes. All right. You then have bucket number 2. This is all about income generation. All right. So dividend stocks, income paying funds, REITs, longer term bonds, income focused investments. The goal here is to generate 4 to 5% yield while providing some growth potential as well. This bucket provides you all the income to refill bucket 1 and supplement your withdrawals. Okay. Then you have the third bucket, bucket number 3, growth assets. Right. This is your growth stocks, your equities, global equities, potentially some alternative investments in there. And this bucket is designed for long-term growth to maintain purchasing power over 20, 30 years. You might not touch this bucket for years, especially during market downturns, but it is crucial for long-term sustainability. The key is this: You don't need your entire portfolio to be liquid or conservative. You just need enough liquidity to survive the volatile periods, the bad years, while your growth assets recover. That is why we have bucket number 1, because that will give you that cushion, that safety net. So when we talk about withdrawal rates, because the famous 4% rule that everyone quotes, go on Reddit, look at Henry and Fire subreddit, everyone talks about 4%. This is where professional advice comes in, right? 4% rule came from research in the 90s looking at historical market data, and it found that withdrawing 4% of your initial portfolio value, adjusted for inflation obviously, would have worked in 95% of a 30-year retirement period in the US. Right? That's going by the US market history. But the problem is that the research was based on the US market data during a period of generally declining interest rates and strong economic growth. So it also assumed 50% stocks, 50% bonds, again, when bonds provided meaningful returns. It's just not where they are right now. Okay? In today's environment, experts believe that the safe withdrawal rate is actually closer to 3.5%. It's a huge difference. Okay? You have $500,000 saved up in your retirement pots. The difference between 4 and 3% is £5,000 a year in retirement income. Okay? So what's even more important than the percentage is that the rates need to be flexible and not fixed. So what do I mean by that? Well, what I mean by that is having a dynamic withdrawal strategy. Instead of saying I'm taking 3, I'm taking 4, or I'm taking 4.5, whatever it may be, you adjust your withdrawals based on portfolio performance and market conditions. Good years, when you've had strong performance, maybe you look at 4 to 5%. Bad years are down, when the market's down, maybe you withdraw 2 to 3%. This flexibility will dramatically improve your chances of long-term success. Okay, so again, you'll have different pots of money that you can pull on. Some are more liquid than others, and that is how you have a sustainable level of income during retirement. So what you want to do is set a minimum withdrawal amount for basic needs, which is your floor, and a maximum for comfortable living, which is your ceiling. Adjust within this range based on portfolio performance. Okay? This approach requires more active management. You must work with a financial advisor in order for this to work, but it provides you much better protection against sequencing risk, which I spoke about at length in this video. You then got to think about where you're going to retire. Okay, so for British expats, it's a little bit more complex. So you need to think about currency risk. Okay, if you're planning to retire in the UK, but like if you're in the Middle East, say, chances are you have dollar holdings, other foreign currencies, reals, dirhams, whatever it may be. Obviously, you're exposed to FX risk. That could really have an impact on your retirement income. I've actually seen a couple of expats that again came to me after the fact that had actually lost quite a lot of money when it comes to withdrawing income or selling assets in one currency and withdrawing income in another, which again is actually why my pension transfers are actually really important, and having multi-currency strategy in place. So you'll be able to build up a retirement portfolio across multiple currencies, where 1 month you need euros, pull euros out, 1 month you need dollars, you pull dollars out. Okay, same with sterling. You might have different assets held in different currencies as well, so 6% in sterling assets, the rest in dollars and euros. Okay. If you have income, if you receive income in one currency but have expenses in another, structure this so that your investments can hedge against the exposure as well. And then you should also consider investments that provide foreign exposure but hedge the currency risk back to your base currency, the base plan. Okay, this isn't necessarily just about investment returns. It's just about ensuring your retirement income maintains its purchasing power regardless of the currency movements. Once you have the pot of money, like I said before, it's just about preservation and then making sure that you can draw the money in the right way from the right pot. From a psychology perspective, this often gets ignored quite a lot, to be fair, and that's the challenges of managing withdrawals in retirement. You're working and investing, market volatility is actually good because it gives you opportunities to top up and buy more shares at lower prices. Market volatility in retirement becomes terrifying because you're dependent on your portfolio for income. Okay, so what a lot of retirees do, they panic. They panic during a market downturn and they either withdraw too much and crystallise huge losses, or they live in fear and they don't want to take any money out. It's no good for anyone. You've worked so hard, you should be enjoying your retirement and most importantly sticking to the plan. Right? Lifestyle inflation, big problem. Some retirees increase their spending during the good market years and struggle to reduce it when there's market downturns. This just destroys the sustainability of the plan. Okay. The dynamic withdrawal strategy that I spoke about previously in this video, this requires quite a hands-on, a lot of attention, decision making that some retirees aren't prepared for. That's why it's really important to have a strategy in place, agree on the strategy and then stick to it, and then work with a professional advisor to make sure that everything is optimised as best as it possibly can be. Okay. So what can you do? Take a systematic approach to it. So you take a systematic approach to the withdrawals. That's remove the emotion from the equation. Set the rules for different market scenarios and stick to them. Again, work with or consider working with a financial advisor. They'll be able to help you navigate these decisions objectively, and they will help you take out the emotion of that, especially during stressful market periods when there's a lot of volatility. Okay. So for those who want additional protection against retirement disasters, there are some other strategies, a bit more sophisticated, but there are other strategies that you can consider. First one would be laddering. Okay, so instead of buying bond funds, you create a ladder of individual bonds that mature at different times. The reason why I say that is that it gives you predictable income and protection against interest rate and credit risk as well. Okay, annuity hedging. Use a portion of your portfolio to purchase an immediate annuity that covers your basic expenses and your basic needs. This essentially creates your income floor, which I spoke about earlier in this video. It also means that you can be a bit more aggressive with the rest of your portfolio because you know that if Armageddon happens, the floor is covered. So, I mean, you've got options as well. That is very sophisticated. I wouldn't say that's for many people, but essentially it'll potentially offer upsides and downside protection as well. Generate additional income or give you the downside protection. You've got real estate, commodities, other alternative investments that can provide diversification and inflation protection. Okay. I would like to think that if you're working with a financial advisor, you will have a nicely diversified portfolio. So that should remove that issue. Okay. But what I would say is that don't always invest in your home country. Global diversification can reduce portfolio volatility and provide better longer term results. The key here is to understand that retirement planning isn't just about accumulation. Okay, it's about sustainable distribution over 30 plus years. So Retirement disasters are completely preventable, but only if you understand the risks and plan accordingly. So I've given you some strategies, I've given you some food for thought. Hopefully you understand a bit more about sequencing risk, building proper asset allocation, implementing different types of withdrawal rates, currency exposure. These aren't just like pie in the sky concepts, these are like the difference between a good retirement and a bad one. You spend a lot of time, decades building this retirement nest egg, and then you wing it when it comes to the withdrawal phase. It's like training for a marathon and then sprinting the last mile. It's just not going to happen. It's just going to be a recipe for disaster. So, listen, you can't really afford to get this wrong. The stakes are very high. You won't get a second chance. Okay. So I hope that you found this useful. I would urge you to, if you're approaching retirement, I'd urge you to speak to a professional to make sure that firstly you're going to have enough, and secondly that your withdrawal strategies are in place. When you work with a professional, they'll be able to give you a strategy that's designed for you, your situation, timeline, risk tolerance, spending needs, etc., etc. They'll be able to take care of all of that for you. So I hope you found this useful, and thank you so much for watching, and I shall see you next time.